Welcome to our Beginner's Guide to Investing for the Future. In this video, we'll be discussing the various types of investments available, how to determine your investment goals, and the importance of building a diversified portfolio. We'll also cover the basics of understanding fees and expenses and how to choose an investment professional or platform. But first, let's talk about why investing for the future is so important. It's never too early to start planning for your financial future, and investing is a key part of that plan. Whether you're saving for retirement, a down payment on a house, or just looking to grow your wealth, investing can help you reach your goals faster and more effectively. By putting your money to work in the market, you have the potential to earn a higher return than you would by simply saving your money in a traditional savings account. Of course, investing does come with risks, but with proper planning and a long-term perspective, you can weather the ups and downs of the market and come out ahead. So, if you're ready to take control of your financial future, let's dive in and learn more about investing for the long haul. The different types of investments. When it comes to investing, there are many different options to choose from. In this section, we'll be discussing the different types of investments available to you as a beginner investor. First up, we have stocks. A stock represents a share in the ownership of a company and can be bought and sold on a stock exchange. When you buy a stock, you become a shareholder, which means you have the right to a portion of the company's profits and assets. Stocks can be a good investment for those looking for long-term growth, as they have the potential to earn higher returns over time. However, they also come with a higher level of risk, as the value of a stock can fluctuate significantly. Next, we have bonds. A bond is essentially a loan that a company or government entity takes out from investors. In exchange for lending your money, the borrower agrees to pay you back with interest over a set period of time. Bonds are generally considered to be a lower risk investment than stocks, as they offer a fixed return. However, they also tend to have lower potential returns. Mutual funds are another popular investment option. A mutual fund is a type of investment vehicle that pools together the money of many investors and uses it to buy a diversified portfolio of stocks, bonds, or other securities. Mutual funds are managed by professional money managers, which makes them a good option for those who don't have the time or expertise to manage their own investments. Real estate is another investment option to consider. This can include buying and owning property, such as a rental property, or investing in real estate through a real estate investment trust. Real Estate Investment Trust. Real estate investing can be a good way to diversify your portfolio and potentially earn passive income, but it also requires a significant amount of capital and comes with its own set of risks. Finally, there are other options to consider, such as cryptocurrency and collectibles. These types of investments can be more speculative in nature and come with a higher level of risk. It's important to do your research and understand the potential risks and rewards before diving into these types of investments. As you can see, there are many different types of investments available to choose from. The right investment for you will depend on your financial goals, risk tolerance, and time horizon. In the next section, we'll discuss how to determine your investment goals and the importance of building a diversified portfolio. Determining your investment goals. When it comes to investing, it's important to first determine your goals. This will help guide your investment decisions and ensure that you're on track to reach your financial objectives. One of the first things to consider is whether your investment goals are short-term or long-term. Short-term goals, such as saving for a down payment on a house or an emergency fund, may require a more conservative approach to investing. On the other hand, long-term goals like retirement may allow for a more aggressive approach, as you have more time to ride out the ups and downs of the market. Another factor to consider is your risk tolerance. Some people are more comfortable taking on more risk in pursuit of higher returns, while others prefer a more conservative approach. It's important to be honest with yourself about your tolerance for risk and choose investments that align with your comfort level. Finally, your time horizon is another important factor to consider when determining your investment goals. This refers to the amount of time you have to reach your financial objectives. The longer your time horizon, the more time you have to weather the ups and downs of the market, which may allow you to be more aggressive in your investment choices. By considering your short-term V's, long-term goals, risk tolerance, and time horizon, you can better determine the right mix of investments to help you reach your financial goals. In the next section, we'll discuss the importance of building a diversified portfolio. Building a diversified portfolio. We'll get to that in a second. I have a favor to ask of you. If you like this video so far, please subscribe to the channel. One of the keys to successful investing is building a diversified portfolio. This means investing in a mix of different assets, such as stocks, bonds, and real estate in order to spread out your risk. Why is diversification so important? By investing in a variety of assets, you can mitigate the risk of any one investment performing poorly. For example, if you only invest in stocks and the stock market takes a downturn, your entire portfolio will likely be affected. However, if you also have investments in bonds and real estate, the impact of the stock market downturn may be lessened. So, how do you go about building a diversified portfolio? One way is to use the asset allocation approach, which involves dividing your investments among different asset classes based on your financial goals, risk tolerance, and time horizon. For example, a younger investor with a long time horizon and a high tolerance for risk might allocate a larger portion of their portfolio to stocks, while an older investor with a shorter time horizon and a lower tolerance for risk might allocate a larger portion to bonds. It's also important to consider the specific investments within each asset class. For example, within the stock asset class, you might invest in a mix of large cap, mid cap, and small cap stocks, as well as stocks from different sectors and industries. This helps further diversify your portfolio and reduce risk. Diversification is an important aspect of successful investing, and it's something that you should continually review and adjust as your financial goals and circumstances change. In the next section, we'll discuss the importance of understanding fees and expenses when it comes to investing. Understanding fees and expenses. When it comes to investing, it's important to understand the fees and expenses associated with your investments. These can eat into your returns and impact your overall investment performance. There are several types of fees that you may encounter as an investor. Management fees are charges assessed by the fund manager for overseeing and managing your investments. Transaction fees are charges for buying and selling securities within your portfolio. These fees can vary depending on the investment platform you use. In addition to fees, there are also other expenses to consider, such as the cost of buying and selling securities and the cost of maintaining and storing physical assets, such as real estate or collectibles. It's important to carefully review the fees and expenses associated with any investment you're considering, as they can significantly impact your returns. For example, let's say you have a $10,000 investment that earns a 7% return in a year. If you're paying a 2% management fee, that's $200 less in returns for you. Over time, these fees can add up and significantly impact your overall investment performance. One way to minimize your investment fees and expenses is to look for low-cost investment options, such as index funds or exchange-traded funds (ETFs). These types of investments tend to have lower management fees than actively managed funds and can be a good way to keep costs down. In the next section, we'll discuss the importance of choosing the right investment professional or platform to help manage your investments. Choosing an investment professional or platform. When it comes to investing, you have the option to work with an investment professional, such as a financial advisor or a wealth manager, or to manage your investments on your own using an online platform. Both options have their pros and cons, and the right choice for you will depend on your financial goals, risk tolerance, and personal preferences. One of the benefits of working with an investment professional is that they have the knowledge and expertise to help you make informed investment decisions. They can help you create a customized investment plan that aligns with your financial goals and risk tolerance, and provide ongoing guidance and support as your needs and circumstances change. However, working with an investment professional often comes with higher fees, which can eat into your returns. On the other hand, using an online platform to manage your investments can be a more cost-effective option. Many online platforms offer a wide range of investment options, including stocks, bonds, mutual funds, and ETFs, and often have lower fees than working with an investment professional. However, you'll need to have some financial knowledge and be comfortable making your own investment decisions. When choosing an investment professional or platform, it's important to consider a few key factors. These include the fees and expenses associated with the investments, the reputation and track record of the professional or platform, and the services and support they offer. By carefully considering these factors, you can choose an investment professional or platform that best fits your needs and helps you reach your financial goals. In the next section, we'll wrap up our beginner's guide to investing for the future. Congratulations on making it to the end of our beginner's guide to investing for the future. But the journey doesn't end here. If you're ready to start improving your financial well-being, take action now. Check the first link in the description for our ebook. It's never too late to start making smart financial decisions. By now, you should have a good understanding of the different types of investments available, how to determine your investment goals, and the importance of building a diversified portfolio. You should also be aware of the fees and expenses associated with investing and the factors to consider when choosing an investment professional or platform. Investing for the future can be a daunting task, but with proper planning and a long-term perspective, you can achieve your financial goals and grow your wealth. Remember, it's never too early to start investing, and the sooner you get started, the more time you have to ride out the ups and downs of the market. So don't be afraid to take control of your financial future and start investing today. Whether you choose to work with an investment professional or use an online platform, the key is to do your research, understand the risks and rewards of different investment options, and make informed decisions that align with your financial goals. We hope this beginner's guide has been helpful in getting you started on your investing journey. Good luck and happy investing!